Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of ZANA Investments, Tim Little. And on today's show, we have here with us Natalie Kolodij. Natalie is an IRS enrolled agent and real estate tax strategist. She's worked exclusively with real estate investors since 2017 and cultivates tax strategies for those building wealth through real estate. She started her investing journey flipping mobile homes to resell on owner financing and now focuses on buy and hold. Natalie, welcome to the show.
Thank you so much for having me, Tim. I'm excited to be here.
Yeah, and it's great to have you. This is going to be a lot of fun because usually we have multifamily investors on the show, but you're one of the people that really helps us be successful. So I'm looking forward to hearing some of those tips and tricks. Before we get into that, though, please tell us a little bit more about yourself and how you got to where you are today.
Yeah, absolutely. So I ended up getting involved with tax and real estate kind of at the same time. I started exactly how I tell people not to, and I had signed up for one of those like weekend guru courses. And I had so many questions afterwards that I ended up stumbling into bigger pockets trying to find kind of answers online. And so at the same time that I was learning real estate on the forums, I had just started working in CPA firms. So I also started providing tax answers to people related to real estate as well. And so that quickly parlayed into me becoming really specialized in real estate tax. And then in 2017, I started my own firm so I could just work exclusively with investors because there's sometimes a disconnect at normal accounting firms with kind of understanding everything that's going on in the real estate world. So it's really allowed me to just really focus down my knowledge base and take advantage of kind of everything there is to offer when it comes to real estate and taxes.
Yeah. And so you mentioned what I think you're absolutely right is basically a gap in that market, right? There's a lot of tax generalists there, but there's not a whole lot of tax specialists, especially that understand investing in real estate. They may understand buying, selling your personal house, but they don't understand the nuances. And I think the impact that has on the real estate investors is that they're leaving money on the table or they're paying too much taxes. So I think it's really important that people understand that if they are seeking to build their wealth through investment in real estates, that they find a tax professional who understands it, because otherwise they're going to be stunting their own wealth building.
Yeah, absolutely. There's a huge disconnect, and not just on kind of the knowledge base, but understanding what and why you're doing. That was such a big part of it, working for CPAs who were like, oh, I used to own rentals. They never make any money. They're just a headache. And so it was like trying to do the best for my clients while the person in charge was like, what they're doing doesn't make sense was really hard to like, you shouldn't be working with anyone who is not also understanding of not even just what you're doing in real estate, but like why. Like if they don't believe you can make money in real estate, they're not going to do their best to maximize what you're doing because they're not on board with it. They look at it like something silly or not a solid investment or not a real business. So if they have that mindset, you're never going to get ahead. Like there's a huge disconnect.
And that's not only the case with tax professionals, right? Like anyone, even just starting out in real estate investing, is going to find if they go to a regular realtor, that person may not be able to help them in the same way that a realtor who understands investment properties will, because they'll say, oh, okay, they're trying to get this much in cash flow per door and how much can it be rented out for. A regular realtor isn't going to think of those considerations. So you almost have to find a specialist for every one of these fields, whether it's financial advice or tax advice or finding the properties that you're looking for. And that's part of building that team, especially when you're starting out, like creating that circle around you of people who are smarter than you at their respective jobs so that they can help you be successful. I wanted to start following up with some of the ways that people really get started in this business and probably what they're going to come to you as their first questions. So, I guess when you're working with someone who, say, just starting off in real estate investing, they have one, maybe two single family homes that they've built up after a few moves or something like that. What is your first piece of advice that you give them that you often see that they were not taking advantage of necessarily?
Yeah, I think the kind of biggest first advice that I give people is create systems early and figure out your actual profit early on. A shocking amount of people I feel like one of two things happens in real estate. People either get that analysis paralysis and they kind of never grow, and they'll create systems all day long. Like they'll have like a whole system of account tracking for a rental they don't own yet. Or it's someone who hit the ground running and now they've got 10 doors and they're like, oh, I don't know how much I'm really making. So from the start, setting up either like Stessa or QuickBooks or something where you're keeping track and you can tell what your actual numbers are. Because a lot of people don't realize they are not actually doing as well as they think, or after that repair they put out of sight, out of mind because they put them on credit or whatever the case, a property might be not be doing so well. And the other thing is people come to me because they want the tax strategies, right? They want savings. They hear these like really sexy strategies on podcasts about how you pay no taxes. But the starting point for any of that is knowing the numbers to begin with. So before we can apply any kind of advanced strategies and like entity structuring or setting things up to save you money with real estate, we need to know the starting point. We need to know what we're actually working with. So from the start, build a system that works for you, that you can grow with. That's another big thing before you try to go 8 levels deep on a really advanced strategy foundation.
Yeah, and I think I'm guilty of that as well. When I started out, my first investment property was a duplex. And the first thing, make sure you buy it. I got it at a decent price. It appraised for more than I bought it for. So I was happy. But you start to see these fees and expenses rack up. And it's, oh, a tenant moved out and they left all their stuff there. I just had to pay $3,000 to have someone clean it out. I'm paying 10% for the management every month. And then AC breaks and all that stuff really starts to add up. And despite the fact that, yeah, you're getting more in rent than you're paying for the mortgage, you have to take into account all of the other expenses associated. And it's easy to just bury your head in the sand and pretend those don't exist.
You
But you're absolutely right. And I did exactly that. And just, I don't want to say hoped and prayed that appreciation would save me, but I think that's what a lot of people do.
Yeah, and what I see pretty often is people who start, especially with small, like single family homes, and especially at lower price points, because it's that low barrier to entry, right? So people are just jazzed to get something, and they've got like 10 doors that were all like $50,000 properties in Ohio. And then they come to me, it's like year 3, and they're like, oh, I'm not actually making any money. Like, I had a bunch of these, but they're not doing great. And then they sell off the whole portfolio of these like little sprinkling of houses and move that into something. Typically, they move into small multifamily is like the next step I see because it's easier to systemize, it's easier to make better cash flow on. So I see this over and over again with people where they're just so excited to get into it and just like keep rinse and repeating that they're not really looking at, well, wait, I'm only making $80 a door and this is going to take me 25 years to retire. So they reevaluate and create a new path.
Yeah, that freedom number that doesn't get much closer if that margin of profit keeps getting smaller and smaller.
Yeah.
You're right. And you talked about people building up these small portfolios and then offloading them. Do you find that most people just sell and take the tax hit and then buy something else, or a lot of folks going the 1031 exchange route?
Yeah, there's two different options. So with your rental real estate, there's something called your passive losses, basically. Rentals are passive. This is part of the great part of them. And it means any of your income doesn't pay payroll taxes. So those normal extra taxes you pay on your salary, your paycheck, any business income, rentals don't pay that. The trade-off is if you have a loss from your rental, you can't always deduct it. There's an income limit. Basically, if you earn over 150,000 a year, you might not be able to deduct those losses against that salary each year. The trade-off is they build up. You don't lose them. They're just accumulating. So one of two things happens. People buy these rentals, hold on to them for 5, 10 years before they are like, oh, wait, this isn't really getting traction. And those low dollar properties don't tend to appreciate very much. And so they'll sell the whole portfolio. And then at that point, if they've got enough of those losses, it's going to offset the gain. So they might be able to just sell tax free and just have this available chunk of cash to use to move into whatever they want. The other option we see a lot is a 1031 exchange. And if you don't know what that is, it lets you sell a real estate, any type of real estate investment asset, and defer the gain. Doesn't disappear. You're basically just like rolling it into the next purchase. As long as you sell and buy another piece of real estate, basically of equal or greater value. So a lot of people do this and they just keep kind of deferring that gain. But it's a great option because, like in the example we've been going with, if someone sells 10 small single family homes, and let's say their profit on all of those, the like cash they would have walked away with is 100 grand, that's enough to put as a down payment on a small multifamily. So it's a great way for people to kind of not lose any of it to that tax hit and then use it to get into something bigger.
Exactly. Yeah. I mean, you're basically kicking the can down the road, but in theory, you could kick that can forever, which
Mhm.
is great because you're consolidating. And that, as you talked about before, the costs and associated with running those 10 single family properties maybe go, not necessarily go away, but become smaller as you scale up into, say, a 5 unit multifamily building. So I think it really is a good way to start scaling up. And the other first way that you talked about, just selling it and taking the tax hit, but offsetting that with the losses, I think it's really important for people to understand because that's where you really get into that tax strategy, right? If you know that you're going to have losses or you're going to have a big capital event where you're going to have a whole bunch of get a tax hit, basically, as long as you have those losses and you've planned for that, then you can offset these things. I think too many people go into tax planning with, oh, it's almost December. I better start thinking about
Mhm.
taxes. Whereas that's something that should start at the beginning of the year and be continuous from there on. Would you agree with that?
Yeah, oh, absolutely. And on the topic of those losses, I'll say these are one of the things I see kind of or missed the most because what happens is anytime you like switch software, if you were doing it yourself or you switch preparers, that's something that has to be accounted for if you've been accumulating them over the years. And it gets overlooked a lot. I've seen a lot of people not realize they had these losses for the first 10 years they owned a rental. They switch from like one do it yourself software to another one. And if they don't enter that backlog of losses, they're like, there's no way for the IRS to know. Like you have to keep track of it. So make sure if you have losses on your rentals and you make more than 150,000 that you're kind of keeping an eye out for that passive loss worksheet and make sure it's carrying on with you year to year so you don't lose track of this huge tax benefit.
Yeah, absolutely. So going on with again the tax benefits for folks who may be starting out in this, is there any special considerations for those who are doing house hacking on say like a duplex or a triplex? They're living in one unit and they're renting out the other units.
Yeah, so this is an awesome strategy and I see this from a lot of new investors. It's a great way to get into real estate. Tax-wise, things you want to be mindful of is keep in mind that even though you're living part of it, if you go to sell that, only your primary unit qualifies for that tax-free primary gain exclusion. So normally if you sell your primary home, you can sell it tax-free. You can exclude up to $250,000 of gain if you're single or 500 if you're married. But if it's a fourplex and you're only living in one of the four units, if they're all the same size, only 25% of your gain qualifies for that. So this surprises a lot of people and they don't realize this. So be aware of that. And the other thing to be mindful of is that you need to kind of treat it almost like in your brain, if you can think of it as two different properties, like you have a primary home and three rentals and they just happen to be attached. That really helps for keeping track of stuff. So if you're buying like flooring for your primary unit and also the three rental units, pay for them separately because you want to keep your business expenses separate from your personal.
Yeah, no, that makes a lot of sense. And that's good advice across the board, right? Just in terms of that segregation of money being used for business and money being used for personal stuff. So one of the first things I did was just get a business credit card. Way it just made it that much easier for me. I didn't have to think about it. Anything that's business goes on the business credit card. And then it makes it easier for you too, I'm sure, at the end of the year, because then you could just print out the things from that credit card statement and run through that. It's a lot easier than trying to go between bank accounts. But the other thing is the bank account, right? Having that business bank account. And none of this stuff is really hard. And you could correct me if I'm wrong on this one. I think the only requirement is having that EIN. And that I believe that requires setting up the LLC, but that is neither hard nor expensive. What are your recommendations to people on that piece?
Yeah, if you are house hacking, and I'm not an attorney, so check with your attorney about an LC, but already on like a four unit, if you're living in one, I wouldn't recommend an LC necessarily because there's literally no way to keep it fully separate business and personal. So that corporate veil, that separation's already kind of smudged. But what I typically recommend to people, don't like overcomplicate it. People do this a lot, I think, and I think it's just overwhelming at first. So as long as you like it doesn't have to even be a business bank account at first. Like it's good if it is, but if you just have a spare bank account and you're just keeping them separate, that's a great start. It's like something is better than nothing. What you don't want is to hit December and be like, oh crap, what just happened? Because you have a whole year of all of your spending for those units. And it's even worse with short term when people are doing like a Costco run to get supplies for their 2 Airbnb units. And also while they were there, they bought all their stuff personally. Things like that, just keeping that separate is kind of a huge, that's the biggest thing. And then just doing it in a way that makes sense for you. I keep telling people that like any kind of bookkeeping or accounting system, it's like a diet. Like people will argue all day long about what's best, but ultimately it's just whatever you'll actually keep doing. Like that's whatever's best for you. So figure out a system that like brings you the least amount of pain to have to do it regularly and stick with that to just keep track of everything.
Yeah, and when you were talking about the keeping it separate with a duplex or triplex, thinking of it as one unit being your home and the others being ones that you rent out, it reminded me of like the home office deduction, which I think gets overhyped a lot, and it's not as straightforward as people might think. So can you please clear the air on the home office deduction and give us a little insight into, again, when it makes sense and what the requirements are for that?
Yeah, so the home office deduction is just a write off if you operate a business from your home in any kind of way. So it doesn't have to be a full office space, it just has to be a dedicated workspace. So it can't be like your dining room table. But if you have like a spare bedroom that has a desk set up in it, or if you have like a corner of your living room set up as a little office space, anything like that is fine. The deduction itself isn't very much, and it also can't create more of a loss. So if your rentals are already negative or at zero, it's not going to give you any more benefit. There's a few ways to deduct it. There's two different ways. There's a standard way that's just $5 a square foot. That's what a lot of people do because it's easier. But again, that's not a big deduction. The biggest reason we look at this home office deduction is that normally any of your commuting miles, like if you were just driving to and from the office, aren't deductible. But if you're going from one work location to another work location, now those miles are deductible. So having a home office makes it so that if you were going from home to the bank or home to one of your rentals, those miles count without there having to be another business stop in between. So that's the biggest benefit of it is increasing your deductibility of mileage. And this used to be something that especially like older accountants would be like, this is a huge audit risk, never take a home office. But like we have the internet now, so this hasn't been as like in 2013 or something, the IRS was like, it's okay. We understand people work remotely. This is a thing. So it hasn't been like this huge red flag in a really long time. So don't get scared out of it if you legitimately qualify for
Yeah, thank you. Thank you for clearing that up. Because
it.
again, I think there is a lot of confusion on that. And I don't want people to think they can write off their whole house or something because they use a room in their house as an office.
Right.
And I think to that point, as people move up in this business and they start to get more heavily involved, then you get the subject of real estate investor or real estate professional status. It starts to come up a lot in conversations and on forums and in videos. So please talk to us about the real estate professional status. And again, who it makes sense for and who it really doesn't.
Yeah. So real estate professional status is something that came around because there was a new extra additional tax that was being imposed on certain investment types. And so some people were like, wait, real estate, even though these are investments, this is my full time job. This is what I don't think I should be subject to that. So that's why we have this special status. And what it basically does is what we were talking about earlier with those passive losses, where if you make too much, you can't always deduct those against your other income. It removes that limit. So it makes your losses technically non passive. So this means even if you make like $500,000 as a real estate agent, if your rentals have losses that are $200,000, you can still deduct them. There's no cap there. So a lot of people try to get this status because it's a huge benefit. It is really hard to get if you work a full-time job that is not full-time in real estate. I see people push this a lot. This is something people are always trying to like argue for. The two biggest rules for it are that you have to spend at least 750 hours in real estate and more time on real estate than any other activity. So this is what hangs up most people because if you work a full-time job, that's over 2,000 hours a year. I think there's only been one court case where the tax court like allowed someone with a full-time job to take this. And it cracks me up because like there was just a post where someone was like, anyone can get real estate professional status. I just saw it explained. If you're working on your rentals after work from 6 to 9, and then both days on weekends you're there for 8 hours doing renovations, you can easily hit that 2,000 hours. And I was like, but no one's doing that. Like in the real world, an IRS auditor would look at that for 1 second and be like, but when did you sleep? Or grocery shop, or like, did you have kids? Were you feeding them? So That's not something I would be overly aggressive on, especially if you only have one or two houses. Like it is a really hard argument to make because there's a huge benefit. So it's an awesome tax strategy and be aware of it. And one of the best perks is if you're married, only one of the two spouses needs to qualify. So if one of you hates your job and the other one has a high paying job, and that's great for getting loans to keep buying new properties, awesome. You keep working, the spouse who hates their job gets to quit and manage the properties, and now you have the best of both worlds. So it's a great status. Be aware of it, like bring it up with your accountant, especially you might qualify for this a few years from now. This is really important because what happens is when you qualify, being able to deduct losses, it's only from that point forward. It doesn't like allow you to deduct any of those prior losses. So you don't want to do something like a cost segregation the year before you qualify because you'll create a big loss and then it'll be stuck. Basically, you won't be able to access it. So make sure if this is a potential on your horizon that you talk to your accountant and bring it up and make it known before you make any other big real estate moves that could create losses.
Yeah, and we'll get into cost segregation in a minute, but I wanted to reemphasize some of the stuff that you hit on there because it's really important that people understand. Maybe like a practical example, if they have a couple of duplexes, let's just say, and they made $20,000 that year, but they had 20,000 in losses, we'll say paper losses, then they could wipe out that real income that they gained for that. If they had 40,000 in losses, that other 20,000 can't be used because of what you just talked about, where it's passive, not a real estate professional, so they can't write all of that off. And I think, and correct me if I'm wrong, that would be carried over though to the next year.
Yeah, you don't lose it. And passive income and loss, they're in the same bucket. So you can always offset against its own type of income. So, like if you have two rentals that are just doing awesome, making tons of money, and a rental that is just a total money pit, you'll be able to use the losses from that third one to offset the other two, but you might not be able to use it against your W 2 income.
And I think that's why the real estate professional status can be a game changer when you get to that point because of the bringing it, taking it off that W-2 status, especially for married couples, being able to claim all of those losses and then maybe go down in a tax bracket, which could save you considerable amount of money.
Yeah, it basically it like my eyes light up when someone calls me and they say my spouse is a stay-at-home dad or mom. I work this $400,000 a year job at Google. We're buying rentals because that is like now it's just an algebra problem. How many rentals do you need to buy this year? How much do you need to spend on real estate for us to wipe out your income? So this makes it a lot more plausible to get into real estate deals that might not, and like I'm not advising it to buy crappy deals, don't come for me. But there might be a deal that's like not that great, but you love the area, it's a great property, and having a huge tax benefit from it. If we can do a comp seg and create, if we can reduce your other income, so you're saving $70,000 in taxes, does that offset the fact that this property might only be breaking even this year and not cash flowing $400 a month if you still essentially made $70,000? So it kind of just opens you up to some more options. But again, talk to your accountant. Don't just dive in and assume you can do this, but it does give you more possibilities for what you can buy, what makes sense.
And what I've seen is in some instances, like you said, that other spouse maybe is a stay-at-home mom or dad. They have the opportunity to maybe become a realtor. And if they're doing that's something they could do out of the home, and then they get that real estate professional status, which in that example that you brought up, they already have those other properties, then they're already, it makes more sense in that scenario for them to have that because then they can immediately take advantage of that situation.
Yeah, and it's definitely easier to prove to the IRS if you are working as an agent as well versus just on rentals. There's kind of a higher bar if it's for managing rentals because rentals can be so passive. So you have to prove if you're saying I have three properties, I spend 1,000 hours a year on them. Why? If this guy spends 12, like what are you doing? You can't like force time. So if you're actually working as an agent all year, that's a like that is much easier to show that point of putting in enough time during the year because you're just a handful of deals can get you to that time allowance for the year, that's 700 hours.
Yeah, and so what is the requirements on that in terms of meeting that level of scrutiny that the IRS is going to have? I think You just need to keep track of your time. But can you go into that in a little more detail?
Yeah, so what they really want to see is an ongoing log of your time. They don't want you to like reconstruct this later kind of thing. So this is maybe the biggest pain of this is having to keep track of all of your time. But I actually have a free download on my website that's an hour tracker, that's an Excel that mimics the IRS's audit log for this. So you can look up the passive loss audit guide and it explains what they look for when they're auditing this. And so there's a specific log that shows exactly what they want to see for your time. They want to know like which property it was spent on, what you did, how much time. And the biggest thing we see taxpayers get nailed for when it comes to the status where it gets thrown out is like inflating their time. Like if you have an hour booked for every time you pay a mortgage, no, it took you like 12 seconds to do that on the bank website. But stuff like that where people are trying to fluff up time way too much, that it gets thrown out. If you're forcing a lot of the time, there's a good chance they're gonna squash that option for you.
Yeah, and that makes a lot of sense. And so you did mention cost segregation earlier. Can you first give us a definition of cost segregation and then talk about some of the scenarios where that might make sense and whether there's a threshold that needs to be reached in terms of what you're investing in before it does?
Yeah, so a cost segregation, if you own any business asset, there's set lives that you get to write off the value of the asset across. The theory is that if you bought something really expensive, it's going to make you money across more than this 1 year. So you don't get to write it all off only in this 1 year. They want to spread it out. So for houses, that's normally 27 and a half years, or it's 39 years for commercial property. But what a cost segregation says is wait a second, you didn't just pay for a house. Like, I mean, it's a house, but there's a bunch of stuff inside of it, there's components to it. So, this lets an expert, normally an engineer, kind of break apart the cost value of what your house is made up on. So, now instead of just having this $400,000 value for a house, it might be 200 for a house. And then the other 200 might be split up between appliances and flooring and kitchen countertops and cabinets and things like that. And this matters because there's a lot of things that have a life that is shorter than that 27 and a half years. So right off the start, if we get to take that other $200,000 and deduct it across 5 years or 7 years instead of 27, that's a much bigger write-off per year. And then on top of that, there's something in the tax code called bonus depreciation that basically says, hey, if something's life is less than 20 years, we decided that you can make the choice to write that off the first year if you want to. So right now, that amount is 100%. So what that means is any asset with a life of under 20 years, you can write off 100% of its value year one. This actually ends 2022. Next year for 2023, it drops down to 80%, and then 60, and then 40, and then eventually it's supposed to go away, but don't quote me on this, but I wouldn't be surprised if they like sign a new bill that keeps it because those who make the laws on real estate. But so what this lets us do is front load a big write off. So you can create a large paper loss in those early years or that first year because we've taken that extra $200,000 of shorter life assets and applied bonus depreciation, creating a large paper loss year one. So what this means is that your property can and should still be profitable. So at year end, you should have cash in hand, basically like money in the bank account. So if at the end of the year you had $40,000 of income after all of your operating expenses, you know what you paid for taxes, mortgage, you have $40,000 left. But then for depreciation, we can create this large amount with a cost segregation that's $200,000. Now for tax purposes, you have a loss of $160,000 and that's what you are taxed on, or in this case not, even though in hand you have $40,000. So this is what we mean when we say you should have rental losses, not that you should buy properties that literally you're wasting money on. Like, don't go buy crappy properties. Paper losses is what we're after.
Yeah, and that's so important for people to understand because it continues to scale as you move up, right? I mean, even for those who are passively investing in, say, multifamily syndication, they can still take advantage of some of these tax benefits. And I think a lot of people don't realize that as well. Because when we put a deal together, a lot of the times we're doing these cost segregation analysis and doing bonus depreciation. So we're getting anywhere between 60 to 100% of that depreciation year one, depending on the circumstances. And so what we do is we pass that depreciation down to our passive investors as well. It doesn't just stay with us. So if someone puts in 100,000 and say they made 10,000 that year from distributions, that 10,000 could easily be wiped out by that year one distribution that they see in their K1 that they get from their sponsor, their syndicator.
Yeah, absolutely. And then on top of that, same thing where even if they can't use the full amount of big loss generated from that cost seg year one, what it does is for a lot of clients, when they exit out of syndication, that loss makes it so that a lot of their gain on the sale event isn't taxable as well. So depending on timing, depending on each person's tax circumstance, you're always going to get a benefit from depreciation and creating a loss, even if it's not immediate. It might be in other ways, but there's always a huge benefit.
Yeah. And like you said, timing is very important. So again, if you know that in the passive investor example, that one of the deals that you invested in is going to be going full cycle and they're going to sell it that year, then that's going to be a sizable taxable event when you get that big paycheck. Good problem to have. But at the same time, you want to figure out the ways to offset it. So what I recommend to people is, hey, this is part of your tax strategy. If you know you're going to have this property going full cycle, you probably want to start looking at another property to invest in if you have the funds to do so that you can get that year one depreciation, which is going to be the biggest chunk because they're doing a cost segregation analysis, and one will offset the other. Maybe not completely, but still, it'll certainly help.
Yep, absolutely. And you can apply that with your personal rentals too. They call it a lazy person's 1031 because instead of having to sell and purchase something new, you're still selling and purchasing something else as separate events, but creating a loss on that new property so you can wipe out the gain on the old one. So it works across the board.
All right. Another fun one that I see a lot on like TikTok and stuff like that, which obviously you should be taking all of your financial advice from TikTok. It is that you can have your kids work for you and write it off and all that. And I have kids, so I can't wait to have them work for me. But can you kind of go through some of the unique benefits of hiring our kids and what the stipulations are so that we're not violating child labor laws or anything like that?
Yeah, absolutely. And this is, like you said, you see this a lot on TikTok and Instagram, and like it is it is an awesome tax strategy. It is 100% legitimate. The problem is I think a lot of people push it at an extreme. And this is when we lose stuff. Like we can't write off employee expenses like anything you pay for as an employee anymore. And it's because people were abusing it. So I strongly discourage people from like listening to the TikTok gurus who are going to be like, here's how you make $1 million doing this, because this is why we can't have nice things. Like they're going to take it away. So you can absolutely employ your kids. And the reason this works so well is because if you earn less than the standard deduction amount, which for the upcoming tax year, it's about $13,000. If you earn less than that, you don't have a tax obligation, right? Because if you made $12,000 and that deduction is 13,000, right? So what this means is that you can pay each of your kids up to that amount and they won't have to file taxes on it. So what this is doing is taking $13,000 out of your business income, which would be taxable at your ordinary income tax rate, and you're making it tax-free by shifting it to your kids. On top of that, you can compound this benefit further, and this is what I recommend even if you don't max out that standard deduction, 13,000. If your kids have earned income, they can now also have a Roth IRA. So you can also put $6,500 is what it bumped up to for 2023. You can put $6,500 into a Roth IRA for them, which if you start funding a Roth for a kid when they're 10, you put $6,000 a year in, by the time they're just 18, they're going to have over 50 grand in there when the average 18 to 25-year-old has $4,000 for retirement. So that's a huge advantage because time is on your side. The biggest kind of mess up with this, there's a few protocols. You can only do this out of your LLC, like a single member LLC or a two-person LLC, as long as the owners are only the parents, no third partners. It can't be out of a corporation, or you will pay payroll taxes. But as long as it's out of your personal name, your LLC, or two-person LLC, that's just the parents, there's also no payroll taxes on this. Where we see people mess up is not paying their kids a reasonable wage and not having them actually do the work. This is the part TikTok people leave off, is they're like, pay your toddler $12,000. And I'm like, what did this 2-year-old do? And people are like, call it a model. But like, you can just buy stock photos of cute kids on the internet for like $1.99. So it's hard to prove why your kid is $12,000 cuter. I'm not saying they're not. I'm just saying the IRS might not agree. It has to be a reasonable wage, like the same you pay someone else to do that job. So I keep creating kind of a rolling list of this. So if as you have your kids work for you, if you have some good tasks you're having them do, shoot me an email, let me know. Cause I don't have kids. So I have a really skewed idea of like what they can do at what age. I know when they start like being functional. But when they're little, if they're like helping you sweep at properties and like clean up and doing stuff like that, like pay them a minimum wage or $10 an hour. If they're teenagers probably better at running a podcast than either of us, and they could be paid $50 an hour. Like teenagers in the internet are unstoppable. So you can increase that amount as they get older, and you can really max out that amount once it's appropriate. I would say don't jump into it when they're 2, 3 years old, planning to be able to put almost 20 grand a person aside. And again, if you have multiple kids, this adds up so quickly. If you have 4 kids and they're all teenager age, you can put almost 20 grand per kid aside. So like $80,000 out of your taxable business income to tax free. That's huge. So it's an awesome strategy.
Yeah, that is awesome. And I do appreciate you adding a little context
Yeah.
in this. I agree that it gets a little overhyped and details are left out. Like, hey, they actually need to do work if you're going to
Yeah.
pay. So I appreciate that. But this has been some awesome insights. But right now, we do need to move on to the turbo round. All right. So I am going to ask you 3 questions that I ask every guest in quick succession. And I just ask that you give me your honest answers. So the first question, what is one red flag every investor should look out for?
I would say a big red flag to look for tax wise is if your accountant has your Airbnb or your short term rental on Schedule C of your tax return. Very rarely does it go there. So if you see that, red flag, ask more questions.
And why is that? Can you dig into that a little bit?
Yeah, so the quick answer to it is that short-term rentals, if they're under 7 days and you materially participate, can be non-passive, and then that lets you access losses. That's great. But they don't move to Schedule C, which is for businesses, unless you're also providing substantial services, which is more in line with a hotel. So unless you're offering like meals and daily cleaning, like bed turn down, all of that, then it shouldn't be over there. And if it's on Schedule C, you're going to pay that 15% self-employment tax. So very rarely is that correct, and it costs people additional tax. So just as a starting point, if you see it there, ask more questions because there's a good chance it doesn't belong there.
All right, awesome. All right, the second question, what is a myth about this business that you would like to set straight?
We've kind of touched on this throughout the episode, but a great myth is that when people talk about having rental losses, that your rentals are actually supposed to be losing you money. So they should not. We're talking about paper losses, which is something that you get to write off for tax purposes, but you didn't actually write a check out and like have a cash outflow for during the year. So huge myth, you do not actually want to specifically buy a property to lose money on.
Yeah, because if that was the case, this would be so much easier.
It's really easy.
All right, and the final question, what does success look like to you?
I think success looks like not being pressured or not having to do the next thing. So when you're at a point that you feel like you do not have to buy more properties, but you can, or you do not have to work full time, but you can. I think that is success, is just having that freedom of your time. And I think that's what a lot of us really aim for with real estate.
Absolutely. I hear that so often on the show, the freedom of time and freedom of money.
Now,
All right. And Natalie, this has been amazing. Please tell our guests how they can get a hold of you and if you have anything else that you would like to share with them.
yeah, absolutely. So you can find me on most social medias. I'm at RE Tax Strategist or at Real Estate Tax Strategist on YouTube. And then my website is colotax.com.
All right. Thanks again. We'll definitely have all that information in the show notes. I appreciate you coming on, and I look forward to seeing you to continue to do big things on your journey to real estate millions.
All right, thanks.